Section 4:2 Introduction to Alpha. 4.2 Alpha Persistence and Robustness. Assessing the persistence and robustness of alpha over time is essential in evaluating the reliability and consistency of a manager's ability to generate excess returns. Here are some approaches to assess alpha's persistence and robustness. Rolling window analysis. Instead of evaluating alpha over a single fixed time period, conduct a rolling window analysis. This involves calculating alpha over overlapping periods, such as quarterly or annually, and observing how it changes over time. This approach helps determine whether alpha persists or fluctuates significantly over different market conditions. Extended time horizon. Evaluate alpha over an extended time horizon to assess its long-term persistence. Short-term fluctuations in alpha can be influenced by luck or temporary market conditions. By analyzing performance over a longer period, such as multiple market cycles, economic environments, or managerial tenures, you can gain insights into whether the manager's alpha has been consistent over time. Peer group comparison. Compare a manager's alpha to their peers within the same investment style or strategy. Assessing whether a manager consistently outperforms their peers over time can provide indications of alpha persistence and the manager's skill in generating excess returns. Consistency across asset classes. Evaluate the manager's alpha across different asset classes or investment strategies. If a manager demonstrates consistent alpha generation in various asset classes, it suggests their skill is not limited to specific market conditions or securities, increasing the confidence in their ability to generate excess returns. Factor analysis. Conduct factor analysis to understand the sources of alpha and assess their persistence. By decomposing alpha into its underlying factors, such as style factors or macroeconomic factors, you can evaluate whether the manager's alpha is driven by consistent and sustainable factors or if it is driven by random noise or temporary market conditions. Out-of-sample testing. Perform out-of-sample testing by using a portion of the available historical data to estimate alpha and then assess its performance on subsequent periods. This helps validate the robustness of alpha calculations and provides insights into whether the observed alpha is a result of data mining or data snooping. Sensitivity analysis. Conduct sensitivity analysis by testing alpha calculations under different assumptions, methodologies, or risk models. This helps determine the robustness of alpha to changes in variables and ensures that the observed alpha is not overly influenced by specific assumptions. Consistency in risk-adjusted performance. Evaluate not only alpha but also risk-adjusted performance measures such as the Sharpe ratio, information ratio, or Sortino ratio. Consistent performance in risk-adjusted measures can provide additional evidence of alpha persistence and the manager's ability to generate excess returns efficiently. By employing these approaches, investors can gain a deeper understanding of alpha's persistence and robustness over time, distinguishing between sustained skill and temporary luck in generating excess returns. It is important to note that assessing alpha requires careful analysis, and results should be interpreted alongside other performance metrics, risk considerations, and qualitative assessments of the investment manager. Identifying consistent alpha-generating strategies can be challenging due to several factors. Here are some of the key challenges involved. Market efficiency. Efficient markets quickly incorporate new information into security prices, making it difficult to consistently generate alpha. As information becomes widely available, any exploitable market inefficiencies tend to diminish, reducing the opportunities for sustained excess returns. Changing market conditions. Market conditions are dynamic and constantly evolving. Strategies that may have been successful in the past may become less effective or even obsolete as market dynamics, investor behavior, regulations, and economic factors change over time. Adapting to changing market conditions and identifying strategies that can continue to generate alpha is a significant challenge. Data mining and overfitting. There is a risk of data mining and overfitting when testing multiple strategies or variables against historical data. With a large number of potential strategies and variables to analyze, there is a possibility of finding patterns or relationships that are purely coincidental and unlikely to persist in the future. Such strategies may fail to generate consistent alpha when applied to new data or out-of-sample periods. randomness, and luck. Randomness and luck can play a significant role in short-term investment performance. Even skilled managers can experience periods of underperformance due to factors beyond their control, such as unexpected events or temporary market anomalies. Distinguishing between luck and skill in generating alpha requires a long-term performance track record and robust analysis. Manager skill and persistence. Assessing the skill and persistence of investment managers in generating alpha is challenging. It is difficult to differentiate between managers who have genuine skill in identifying and exploiting market inefficiencies and those who have achieved alpha through random chance. Additionally, identifying managers who can consistently deliver alpha over extended periods is a complex task, as performance can vary based on different market conditions and investment cycles. Survivorship bias. Survivorship bias occurs when unsuccessful investment strategies or managers are excluded from analysis, leading to an overestimation of alpha in the observed data. This bias can distort the perception of consistent alpha generation. As failed strategies or managers are not adequately accounted for. Benchmark selection. The choice of benchmark can significantly impact the assessment of alpha. Different benchmarks may have different characteristics, risk exposures, and performance expectations. Selecting an appropriate benchmark that accurately represents the investment strategy's risk and return profile is crucial for evaluating alpha consistently across strategies or managers. Transaction costs and implementation challenges. Generating alpha may come with associated costs, such as trading commissions, bid-ask spreads, and market impact costs. These transaction costs can erode the excess returns generated, making it more challenging to achieve consistent alpha in practice. Additionally, implementing certain strategies, particularly in illiquid or complex markets, may pose execution challenges that impact alpha generation. Given these challenges, it is important for investors to approach the identification of consistent alpha-generating strategies with caution. Thorough analysis, including rigorous testing, robust risk management, consideration of multiple performance metrics, and qualitative assessments of investment managers, can help mitigate these challenges and improve the likelihood of identifying strategies with a higher potential for sustained alpha generation.